are going to be looking for July 21st setups and doing the back testing for it. First thing, mark out session highs and lows and obvious liquidity of the prior day or prior days. 721. I want 720s. So here we have New York PM. And New York PM high. That seems like it'll be the best setup there. PM high. We have London low. All right, so that seems to be the best setup here for the 21st. We have buy side here also, which could be valid. All right, let's take a look. Look at this and see what price can reveal to us. So first, let's look at that PM high. We get I draw on the liquidity here. I'm focusing on the 1 minute currently. Oops, lost my place. 1 minute for the moment. I don't quite get a very nice break in market structure. But that's really the best break in market structure that's going to be given to us. And even then, this in itself is a break in market structure. This right here, break in market structure. Um, we do have a nice drop on that, valid drop. Just trying to figure out how to frame this type of trade. How would I frame this trade? I would mark out, I feel like I would mark out my fair value gap here. And I feel like I would mark out that inversion also. So that would give me my best area to enter. With my stop above. Yeah, let's call that the entry there. Call that the breaking market structure. We'll call this the entry. Just to stop. Then our first target here. I'm just observing the 1 minute, 2 minute, 3 minute. Yeah, that'd be a little difficult to enter. That would almost be, to me, that would almost be entering in real life. This is in theory, the best scenario. You don't want to enter this one quite yet because that's a much larger risk. You, in a scenario like this, you would wait for that top one to trigger, and ideally not right at the moment. You want to see some sign of, hey, you want to see a signature telling you we're going to move down. So here, the signature telling us we're going to move down is we fill the fair value gap. We get into the mitigation block right here. Fair value gap, mitigation block. And then we do not leave this small 1 minute fair value gap. Don't leave that open. If we were to leave that open, come down into here, test the low and the fair value gap, and we were to come up, it's likely we're not going to move down. But here, since we disrespected that 1 minute fair value gap made on the move up, that tells us we're going to move lower. So I would likely market order the moment we get out of here. We break below that. Um, Even so, that's that's almost worth the risk. There, target here. We see fair value gap respected on the 1 minute again. Due to price moving so quickly, so in such a large move on the 1 minute, that tells us that price was pretty volatile here at the open. And that's one of the hard things, playing here at the open on volatile days like this. I played one the other day, uh, and I did good on it, but you do have to have a different mentality for playing the open because the open can be a lot more harder mentally due to volatility, due to uncertainty, and due to the manipulation in the market, because that's when traders get FOMO, retail gets FOMO, and institutions take advantage of that at the open, amateur hours there. So definitely, that's not something you want to trade large size in at opens unless it's a super high conviction trade. Other than that, here, not a super high conviction trade until we trade and below this fair value gap, giving us a disrespect of bullish signature. In other words, bearish signature. Then we get more conviction down here on the 1 minute. Like I said, mostly framed on the 1 minute. 2 minute, 3 minute don't really provide a whole lot. 2 minute, you don't see that conviction, or the 3 minute. Whereas the 1 minute, we see it respected twice. And not only does it respect the fair value gap, it respects the consequent encroachment of the fair value gap. So on this trade here, it's almost a 1 to 2 risk to reward. Take a look on our 1 minute. Risking 700 to make 1,820. We go into drawdown on this trade, a drawdown of 450. So that's tough mentally when you're first starting off the day, right at the open, being in a drawdown 450. 405, I think is what it was. Sorry, not 50. Let me double check. 405 or 400, right at 400. That can be very tough. So that's the first trade of the day. And I believe another opportunity does show up eventually on this day on the buy side, not quite as big. We'll take a look at it. That opportunity is in the PM session. PM session, we see this buy side here taken out, and even this buy side here. I marked the top one, but we could mark the bottom one. Doesn't make much of a difference due to both being right around the same area. I'm also curious, what's right in this buy side in this area right here? Let's look at our lower time frame. There's the buy side. Look at this fair value gap right here. We'll mark that on the 1 minute, and let's see if our 2 or 3 minute, 3 minute also has it marked out. We'll mark it on 3 minute. Look at where price goes. We take out buy side. We touch into the fair value gap. Take out buy side, touch into the fair value gap, and then we move lower. So let's take a look at this here. I think personally, if it were up to me and I saw this, I would likely market sell in this area here before we even create this break in market structure. That's just based off the experience I have, based off seeing this work multiple times over the past weeks. We create a fair value gap. We create a fair value gap here. We got the break in market structure, and I'll actually draw those out. Break in market structure. Here we actually get two break in market structures here and here. Let's see what our 1 minute tells us. Let me get rid of these rulers real quick. Get rid of them. Break market on the 1 minute, but not a significant drop on the 1 minute versus this significant drop on the 1 minute. play that fair value gap there. And look at what I mean by the significant drop. This is a significant drop, but that's not a proper break in market structure. We have a significant fair value gap. Then we also have a market structure here. We have to break. If price were to retrace, I would look for us to go into this where I would put my short order in if I didn't already short up here. I would put it here, but I would be on my tippy toes pretty much looking for if I can get in somewhere else. Does price not want to make it up here once we get down there? When I see this drop right here, this would be like, fuck, maybe I missed it. When I feel that, that's when I know that's a proper drop. That's a proper move up. That's a proper price movement right there. Valid. It's significant. So then I look for that fair value gap. Because we got this break in market structure, if I were bearish, do I want price to go up here? I don't want price to retrace all the way back up here. If I were bearish. Because then that puts us so much closer to taking out the high up here. I want it to respect this fair value gap. Fills it, then we come lower. This is where I want to enter. And just to mitigate my loss, I would probably put my stop above here, above this fair value gap, in case we do want to retrace back into it. But even then, we have a smaller fair value gap here. So really, the ideal entry is right here. At the fair value gap. I believe I like this setup better than the one from the earlier session. Um, just because we get conviction for a 3-minute fair value gap and the draw on liquidity. Stop for this one would be placed above here where I said. My entries, I usually use my entries by market if touched, just due to the accuracy on these. Even it gives me a bit of slippage sometimes. But that's fine. Sometimes, we touch to tick and we might not get filled. I feel like I would be much more frustrated versus that slippage. Slippage, I think about it just as a small fine. I don't get in here, touch it, and get filled all the way here. Very, very rarely does that ever happen. It's possible, but still. So entry stop. Now we need the target. Target opposing session or this opposing session actually. Give me a second. Opposing session is now here. Or we could even target lunch lows, which I think I would much rather target lunch lows. So I'm targeting lunch lows right here because it's the low hanging fruit and because there's not a whole lot of time left here in the market. I mean, an hour or so, but still, I want to be out pretty much. Um, ASAP, in and out ASAP. So there's the second trade frame. I like this one better than the other one. Let's look at our risk to rewards. We are risking about 400, slightly more, a little more, to make 1,400. It's beautiful. Almost 1 to 4. Let me get the 1 minute chart in here. My fair value gap was, I don't remember if that was based on the 1 or the 2 minute. It's based on the 1 minute. So for my annotations, I want to make sure I have that in there. All right, perfect. There's my 1, 2, and 3 minute. This was a good setup, good trade day, I believe. Very tradable. I mean, between both trades, that would net in about 3,400, I believe, between both. Let's double check. So what was those at 3,200. One day, that's trading one contract apiece. Imagine 10 contracts on both. Insane. Insane. 32 grand one day, a $32,000 day. You can't be mad at that.